Today, it appears as if investors are spoiled for choice. The global capital market is practically overflowing with opportunities. The Nigeria Stock Exchange is up year to date by 31.87%. The S&P 500, which is an approximation of the performance of the US stock market, is up 12.04%. On the fixed income side, Treasury bill rates at the last auction that was held last week closed 21.9%. In the bond market, Treasury bond yield went up as high as 22% at the close of business on Friday. This is for the 2033 bonds. Also in the Eurobond market, that is local bonds denominated in dollars, the rate is even as high as 11%. Investing in a single asset class comes with a lot of nuances, and this makes investing sometimes exhausting. Now, when you have to choose between different asset classes, it makes it even more complex. But don't worry. In this episode, I'm here to help you cut through the noise and make your investment decision-making process more simplified. It's another episode of Market Tape, and I'm Nathan KC Nwokoro. Sit back and relax as I help make this whole journey straightforward for you. Muni, play the music. Yo. Welcome to a brand new episode of Market Tape. This is the show where we help you make sense of happenings in the global capital market and show you how you can use my insights to improve performance of your portfolio and take your investing to a whole new level. If you haven't subscribed yet, know this, that you can support this young show by hitting the subscribe button. And if you have subscribed, please don't hesitate in sharing my content with your contacts. It is Market Tape. And don't forget to hit the notification button so that you never get to miss any of our episodes as it drops. Very often, investors are in search of that one single investment they term as a good investment. But for me, I prefer to see it from the lens of appropriateness and suitability. I really don't believe there's that single investment you can say is a good investment. You can only say an investment is suitable or appropriate given the situation or the circumstance. And what do I mean by this? If you're a real estate investor, for example, or a real estate developer, it may make sense in the early stages that all your investment, all your wealth is in real estate. There are billionaires today who became wealthy through investing in real estate. But at some point, you start to notice that there is a problem with having especially as you get older, you start to notice that there's a problem with having all your wealth concentrated in one single asset class, in this case, real estate. And at that point, it starts to make sense to diversify your investment into other asset classes like bonds, the stock market. Again, this is because real estate traditionally is known as being illiquid, in the sense that if you have a need for 5 million naira, for instance, it's not easy to go cut that 5 million from a property worth 500 billion, for instance. So it's possible you're a real estate developer, you have a property that is worth 1 billion naira, but you're looking for 500,000 naira. It's not easy to get that out of real estate. So because real estate is not very divisible and not very liquid, meaning that you can't get your money when you need it necessarily, then it makes sense at some point for you to consider bonds or treasury bills as being appropriate. And the same example can be made for um, someone who is invested his whole life in the stock market. At some point, you start to realize that the level of risk that comes with investing in the stock market may no longer be suitable for you. And at that point, you want to start to diversify into other less risky assets. So you see, it's not always about a good investment. Of course, you can argue that real estate is good. You can argue that investing in cryptocurrency is good. You can argue that investing in the bond market is good. Private equity, infrastructure funds, there are all of these investments out there. But the success in investing actually comes from knowing when and how to make these investments. And that is the thrust of this discussion today. I'm going to try to simplify these investment alternatives for you and help improve how you make decisions as to what to invest in per time. In addition to this, on this show today, I'm also going to talk a bit about the events in the capital market last week. Obviously, we saw some mixed results from various companies in the healthcare sector. I'm speaking of Eli Lilly, Intellia Therapeutics, Novo Nordisk. We also saw results from software companies in the United States like Datadog, Palantir, and Unity Software. We also saw reports from Occidental Petroleum. I'm going to touch about important things we need to, or what I saw from these results last week as this show progresses. Obviously, in speaking about these investment alternatives, for today, I'm going to focus a bit more on the traditional asset classes, speaking of bonds, stocks, and Eurobonds, for obvious reasons. First of all, these asset classes have been in the news a whole lot lately, and the returns globally have reached levels that we've not seen in recent years. The secondary reason is, as you are well aware, many banks today are in the market to raise capital in compliance with CBN's mandate for recapitalization. And because of this, most investors have been inundated with calls from account officers, from stockbrokers to invest in these bank shares. And personally, I've also received a lot of calls from people seeking directions, what to do. Should I buy this or should I not buy? Should I invest in these stocks? So I'm going to share my thoughts around this as the show progresses. But to keep the ball rolling, first of all, we have to realize one thing, that investing in shares means that you're a part owner of that business. And as part owner of a business, you have a stake. And that means that you need to do the minimum due diligence that a smart investor will undertake before investing in a business. So as a shareholder, you own a slice of that business. That to me is the first important point that we need to note. And capital is mobile. You are don't ever feel to be under any obligation to make a particular investment so long as it involves parting with your capital. You don't have to be under any rush. You must do the needed due diligence before committing capital to any investment, whether you're thinking of buying shares, investing in Eurobonds, whatever it is, you must do that minimum due diligence. Obviously, we have today a lot of banks in the market. You have Zenith Bank, Fidelity Bank, FCMB, Access Bank, and GTB. So you have options. So probably you're getting calls from your account officer at Zenith asking you to buy their shares. Know that you could invest in Zenith shares. You also have other options. And to be honest, a lot of other banks will still come into the market. So the opportunities are there, the options are there for you to explore. Secondly, you have the option of even going to buy these shares directly today in the secondary market. For some of these banks, their shares are still trading in the secondary market, and you have the option to go buy directly from the secondary market. You also have the option to not invest in the banking stocks and to invest in other sectors of the Nigerian Stock Exchange. You have the consumer goods sector where you have Nestle, Unilever, Boa Foods, and all of that. You also have very solid companies in the agri sector where you have Okomo Oil, Presco. Those are the two giants in that sector. You also have industrial goods like Dangote Cement, Boa Cement, and of course you even have the telecommunication sector where you have MTN and Airtel dominating that sector. So you have a whole lot of options. So let's not act as if we are tied to just the banking stocks. No, there are too many options out there that you need to explore and convince yourself that you are making the right investment decision. Again, I'm speaking about this because I have sometimes looking at what is going on currently, it feels a bit like it's 2005, 2007 era all over again, where a lot of people invested in stocks, banking stocks, and a host of other companies that came into the market. And at the end of it all, it wasn't a pleasant experience for many investors. So I want to make sure that you're making the right decision. You are reading the room right and making the best decisions for you. Now, one can argue again that the circumstance with these banks is far different from what we had in 2005, 2007 era. The banks are better capitalized today. They have better operational stability today. That argument can be made. Again, most of the banks are undervalued today. Yeah, most of the banks are undervalued. Whether you are looking at their price to earnings ratio, price to book ratio, these banks are trading below valuation. But again, the point is they are undervalued for a reason, and that is where risk comes into the equation. There is some level of uncertainty as to when this undervaluation will be corrected. So if you are investing, you want to make sure again that the amount of risk you are taking making this investment in terms of uncertainty in the correction of their valuations matches your risk appetite. You just want to make sure that you are taking those things into account as you make these investment decisions. So as an investor in the stock market, you are investing for 4 primary reasons. First of all, capital appreciation. You are investing in the expectation that if you invest 10 naira today, the price of that stock will go to 20 naira, 30 naira, and over time. So your capital is appreciating, moving from what you are invested to a higher value. Secondly, you are investing in the hope that your investment protects you against inflation. Investing in the stock market traditionally is expected to protect investors against inflation because the expectation is that you're investing in businesses that have the capacity to pass inflationary pressure to consumers, and that should translate in value growth for such companies. Now, we'll come back and interrogate whether the Nigerian stock market has actually played these roles effectively. The third reason you are investing in the stock market is for diversification benefit. You are investing to reduce the risk of investing in a single asset class. I did mention the example of someone who is invested in real estate. So if you are investing in the stock market as a real estate investor, you are hoping that the return on the stock market behaves differently from the return of the real estate market, meaning that at times when real estate values are depressed, you are hoping that the stock market value appreciates at such points to compensate for whatever you are losing in real estate. You're also investing to diversify with asset classes like bonds, which traditionally are known to feed off in terms of diversification very well with the stock market. And finally, you are investing for dividends because you expect the company to make money and then redistribute this money to investors. So the question is, how well has the Nigerian stock market done in meeting these benefits for investors. Now, so if you look at the performance of the Nigeria stock market over the last 20 years, it's been largely depressed on account of inconsistent policies, weak economic growth, political instability, high inflation, and currency devaluation. Particularly if you look at the period between 2008 to 2022, you see that the market was really relatively flat. There was no movement. You don't see this upward sloping motion that you expect from a typical stock market. It's been a lot of volatility in between, but relatively flat throughout the course of this period. The recent enthusiasm we are seeing recently is the bump we are seeing from 2023 that basically sent the stock market skyrocketing to record levels that we've not seen recently. And this is on account of expectation that the much needed policy reforms will bear fruit finally. If you recall, the coming of President Tinubu ushered in a couple of policy reforms, from liberalization of exchange rate to removal of subsidies, and now recapitalization of these banks. So for the investing community, there is hope, there's expectation that these policies will transform the economy and by extension transform the market. But as an advisor, I always look to historical data. As an advisor, I always allow historical data to drive my decision-making process. So if you look backwards, obviously, in terms of capital appreciation, the Nigerian stock market has not done a good job of growing wealth substantially until the last 18 months or thereabout that we've seen this upswing in the stock market. Now, to the second point, hedge against inflation. If you look at the inflation-adjusted return of the Nigerian stock market, it's also been negative over the last 20 years. If you look at the nominal return is 7.5%, but the real return after adjusting for inflation is minus 6%. That is not what you are looking for as an investor. So the first two roles that equities are supposed to play in a portfolio have not been played very well by the Nigerian stock market. However, in terms of diversification and dividends, one can argue that the stock market has, to some extent, lived up to expectation. We have a lot of companies that have paid healthy dividends, particularly in the banking sector, and some of the consumer goods sector, and even telecommunication. We've seen consistent dividend growth from some of these companies. So in terms of dividends and of course diversification benefits, the Nigerian stock market, in my opinion, has relatively lived up to expectations. Let's zoom in a bit on the banking sector, because obviously that is where we have all the attention at the moment. If you look at the past 15 years or thereabout, which is when we started reporting the banking sector as an index, the performance of the banking stocks have also been relatively flat up until 2023. And you can see it from this chart here. Between 2009 and 2023, the performance was also relatively flat until 2023. So make of these informations whatever you will. Now, obviously, you have alternatives. There are options out there. I did mention that globally, we've had impressive performances from markets around the world. So let me zoom in a bit on the performance of the Nigerian stock market relative to other markets around the world. So if you look at this chart, is the MSCI All Nigerian Index. It's a selection of a couple of stocks, big stocks, liquid stocks trading on the Nigerian Stock Exchange. And for emphasis, the banking sector contributes about 50% to this index. And this chart compares the performance of the All Nigerian Select, as it's called, to the performance of the frontier markets. The frontier market is where Nigeria is classified. Frontier markets are countries that are more advanced than developing country economies, but not as advanced enough to be included in emerging markets. So somewhere they are straddled in between developing markets and emerging markets. So if you look at the performance of the uh, All Nigerian Select, is what you're seeing at the bottom. Is the lowest compared to the rest of the frontier market. And if you go ahead and compare it with what they call the MSCI ACWI, which represents large companies selected from developed markets and emerging markets, it's even night and day when you do this comparison. So if you look at the nicely upward sloping line, it represents the performance of developed markets and emerging markets. And then next to it is the yellow line, which reflects the performance of the rest of the frontier market. And when you single out Nigeria, is the performance you're seeing, the last one below. It shows how the performance of the Nigerian market compares to the rest of the world. And obviously, as an investor, this is not what you want to see. You want to be invested in the ones that are upward sloping. So that is it. Now, it's also worthy to note that these indexes are reported in USD. That is why you're seeing that despite the upward sloping or relatively upward sloping performance you're seeing from the Nigerian market, if you adjust for these values in dollars, you get to see this downward slope for the All Nigerian Select. So obviously there are alternatives. Now, I have also narrowed this down to compare between the performance of the Nigerian market and the S&P 500. And that is what you get to see in this next chart. The difference also is night and day, So as an investor, you want to be sure that you are looking at all of these alternatives and making the best decision for yourself, because ultimately these decisions have consequences. You're not investing for emotional reasons. You are investing for your future. You are investing to achieve your investment goals. You're investing for your retirement, and you want to give yourself the best chance of actualizing your investment objectives. As an aside, there are a couple of factors that I personally consider when I invest in stocks, and I'm going to share these factors with you. So I like companies that have huge free cash flow. It's one of the first things I look out for in any business, free cash flow. I also hate leverage. I do not invest a lot in companies that has a high amount of debt. Also, I like companies with high return on equity, high return on assets, low volatility. I want to sleep well at night, so I'm not going to invest in those businesses that the price is all over the place, that goes up and down every day. I don't favor such companies. And also companies that have consistent revenue growth is also important for me. So I look at the 5-year revenue growth of any business, any stock I'm interested in investing in. If the company checks these boxes, then it's a go for me. And then also, if you decide to invest in any of these banking stocks, you also want to make sure that you are doing it the right way. Back in 2005, 2007, a lot of people invested in these IPOs, and at the end of the offer, took a lot of months trying to figure out where the investment was, getting it credited to their CSCS account. You want to make sure that you are investing in a way that makes it easy for you to get this investment into your CSCS account. By the way, for those who don't know, CSCS is the Central Security Clearing System, which is where all equity investments are held. If you don't have an account, make sure you open a CSCS account first before proceeding. Any stock brokerage firm can help you open this account. And once you have this CSCS account, the next step will be to go online. You can actually make these investments online. For all the banks that have come into the market, FCMB, Zenith, Access, and Fidelity, if you go to invest.ngxgroup.com, it will give you the link to register and then invest directly. You can even pay online. And the good thing here is that if someone is marketing you for these shares, you can actually find that person's firm, whether it's a bank or a brokerage firm, listed on that NGX website. And you can say, oh, let the commission go to this guy who has been marketing me. And then after that, send him the evidence. Oh, I've bought and I indicated your firm as the one to earn the commission. And everybody is happy. At the conclusion of the offer, your investment is credited directly to your CSCS account. You don't need to start calling people. You don't have to start calling me and asking me what to do to get your investment into your CSCS account. Now is the time to know how to do it right. Now, on to the next thing, which is bonds. Bonds basically are IOUs. So a bond means you are giving your money to somebody with the promise that it's going to pay you back your principal with interest. And investing in bonds is for three reasons. One, again, for diversification. Obviously, if you're investing in any of these asset classes in certain proportions, the aim is to hold a diversified portfolio. We can't speak enough about the benefit of diversification. It's important. Now, so investing in bonds means you are seeking diversification. Secondly, you're looking for periodic cash flow because bonds pay coupons. And typically these coupons are paid every 6 months. So if you're an investor looking for this periodic, probably you are retired and you want something to supplement your pension, you can look to this periodic cash flow to supplement your pension. If you are looking for periodic cash flow to pay your children's school fees, you can look to this to use the coupons from bonds to pay for your children's school fees. Just any obligation that requires periodic payments, you can look to these coupon payments. Coupon payments basically are like dividends that you get from investing in shares. They're like dividends. But the difference is that the rate is agreed upfront. You know what the rate is. For shares, you do not know the rate at which your dividend will be paid. But for bonds, the rate is known ahead of time. So it's important we make that clear distinction between how dividends work and how coupons work. And finally, investing in bond is also with the expectation that you are hedged against inflation. So if you look at it, obviously, the investing in Nigerian bonds have played the first two roles well. The last one is what you may not be able to argue for. In terms of diversification and periodic cash flows, we've hardly had any issuer in Nigeria defaulting on their obligations. So periodic cash flow, box checked, diversification checked, but where you have constraint is in protecting against inflation. Obviously, Nigeria has had this very high inflation rate over the years. I think on the average, our inflation rate is about 13%. Long-term trend rate is about 13%, and that is high for even emerging markets and frontier markets like where Nigeria operates. Kenya has their average inflation below 5%, same with South Africa. Most of our peers have found a way to keep inflation low. But over the last couple of years, the last 10, 15 years, our inflation rate has trended around 13%. And that is bad for bonds, that is bad for stocks. And that introduces the next asset class we'll talk about, which is Eurobonds. Eurobonds are essentially IOUs, but denominated in dollars. So as an investor, if you're worried about the impact of inflation on your cash flow, the way to look is in Eurobonds. In Nigeria, the longest tenured bond is the 2053 bonds, obviously. So you have options to match your investment goals from the next 1 year to 2053. And then finally, you have the Treasury bill market, which is one of the highest yielding markets in the world today, the Nigerian Treasury bill. The yield is almost 28% currently. And a lot of investors are piling into this market, because of the attractive rates we are seeing. So as a closing note, the point that should not be lost is all of these investments are trading at very attractive levels today, but it's important to understand how each of them fits into your overall investment goal, how it fits into your overall investment objective. That is what is important. You don't say because the treasury bill rate is almost 28% today, you're going to dump all your funds in there. 2025 rates could come crashing down, and then you are left with this money maturing and not knowing where to put it next, because you don't expect these opportunities to last forever. At times like this, you need to take your investment decision making process to a high level and let a professional do it for you. It doesn't cost much to get a professional do it for you at all. So it's important we have all this information at our fingertips. And then for these fixed income securities, obviously, there are different IOUs trading in the market. You have bonds issued by the federal government, you have those issued by corporations, you have bonds issued in the Eurobond market, you have those issued by other countries like Angola, Cote d'Ivoire, Ghana, Zambia. These two countries recently defaulted on their obligations, and you need to be aware of this, that if you're investing in the bond market, whether the euro bond market or the local currency bond market, you need to look at the credit worthiness of the issuer. The issuer is who you are giving your money to ultimately. You need to be sure that they're going to pay you back your principal and interest. And one way to look at it is from the perspective of the credit rating. You want to make sure that the issuer has a good credit rating. Their commercial papers trading in the market today issued by high quality issuers. Now to the weekly updates. Last week there was a report on the federal government launching its Series 1 domestic bond. This bond is aimed at raising 500 million from local and international investors. This one has been in the works for a while now. And the good thing about this is the minimum investment is $10,000. $10,000. Typically, for the Eurobond market, the minimum investment is $200,000. But I think what the government is trying to do is to sweep monies in domiciliary accounts and then attract money from Nigerians in diaspora to invest in these bonds. So if you have money sitting in your domiciliary account, or you are a Nigerian in diaspora who is looking for opportunities to invest in the Nigerian bond market, I think this one is one that you have to keep an eye on and keep your ears to the ground and see how it unfolds. So this program basically means that the government is going to borrow dollars instead of nairas from investors and then pay, I think what I saw is up to 10% annually on this investment. And the minimum, like I said before, is $10,000, but you can do multiples of 1,000 thereafter. Okay, also we had a couple of earnings reports last week from a few US-based companies, and I'll just run through those reports before we close. First of all is Palantir. Palantir is a data analysis software company that serves the US government and a couple of commercial businesses in US and in Europe. Palantir started out as serving the government through its Gotham platform. The platform is called Gotham. Yeah. And initially, there were a lot of worries about the concentration of their business. Investors were worried about the ability to diversify into the commercial market for their data analysis software. But they've been impressive really over the years. In the current quarter, the government segment grew by 23%, while the commercial segment grew by 55%. And I mean, 55% is impressive. Palantir continues to grow their revenue. But the worry for the company is the valuation. A lot of investors consider their valuations to be very high. The PE ratio is currently about 176, which is way higher than the sector average. The telecommunications sector average is way below 176. So that is a worry for a lot of investors. But I don't necessarily think that that is uncommon for IT companies. Because in the early days you have to most of your revenue is ahead of the curve. So what I want to see is that the revenue is growing at a very high clip, and that is all Palantir is showing today. One company again that released their earning report last week was Datadog. Datadog is another analytical company, but focus more on the cloud and machine learning segment. So what the company does is that they help companies analyze data to be sure that they're managing threats, looking at company automation processes, looking at just generally using large language models to analyze data and help the companies make better investment decisions. That's what Datadog does. They also had an impressive growth in revenue of about 27%. So their revenue continues to grow at a very high clip. However, what investors are looking at, despite the fact that the company beat estimates, okay, if you look at the report, the beat revenue, revenue came at $465 million compared to 425 estimated by analysts. They also outperformed in terms of earnings per share. Earnings per share came at 0.43% compared to 0.36% estimated by analysts. But despite this, the share price was down for the week by 1.56%. I think what most analysts are looking at is the guidance provided by the company. The guidance came at 21% growth in revenue, which is below the current growth rate in revenue at 27%. So the company is saying in the next reporting period, we expect revenue to grow at 21% as opposed to 27% we posted this quarter. And investors obviously are not happy with that numbers. So the share was down for the week. But to me, 21% is still good. It would be nice that they report something in the region of 27-30%. But I mean, you can't be mad at 21%. Again, for Datadog, what I see more is a competition in the segment. They're facing a lot of competition, and their business is focused a lot on a few big clients. But overall, nice company, growing steadily. They have about 3,390 clients as at the last report. They also have Unity Software. They beat expectation in terms of revenue. Revenue came at 449 million, and as opposed to an estimate of 442. Earnings per share came at 0.27 as opposed to 0.5%. So they beat expectations in terms of earnings per share and revenue. But my worry about Unity Software, if you look at the share price over the years, over the past 2 years, it's performed very poorly. From the IPO price, it's down almost over 80%. It's not what you want to see as an investor, obviously. Um, there are questions around the management team at Unity Software, and we'll be keeping that in mind, looking at that to see how those questions are answered. Already, we're hearing about the change in their chief financial officer, the CFO. The expectation is that these changes will ultimately transform the fortunes of the company. The company operates in some sort of duopoly, which is something that they should be taking full advantage of at this moment. But I don't think they've done that very well. Maybe a change in management will help them. Now, to the healthcare sector, we had reports from Eli Lilly, Intella Therapeutics, and Novo Nordisk. I mean, for Eli Lilly and Novo Nordisk, these are the two big companies in terms of diabetes medications. Novo Disc for one controls about 1/3 of the global branded market for diabetes treatment, and Eli Lilly also has a significant market share there. For Eli Lilly, revenue came at $11.3 billion compared to $9.97 billion estimated. So they beat expectations in revenue. They also beat expectations in earnings per share by a wide margin. Earnings per share came at 3.92% compared to 2.77% projected by analysts. And the share was up 5.49% last week, closing at $891.68 on the New York Stock Exchange. Very impressive report, and Eli Lilly continues to show dominance in diabetes treatment, cancer treatment, and a whole lot of other drugs in their pipeline. And one firm that didn't perform so well is the Danish company Novo Nordisk. Like I said, they control about 1/3 of the branded diabetes treatment market, and the earning, it was both a miss for both revenue and earnings per share. Revenue came at 68.1 billion kroners compared to 68.68 billion kroners that was estimated. Earnings per share came to 4.49 compared to 4.97. And the reason for this is the supply constraint they had with the sale of their diabetes medication, the injectable diabetes treatment medication. And that initially led to a decline in the share price. I think it came as low as came towards the lower 120 band last week. But after the report from Eli Lilly that indicated that some of those concerns were starting to ease, obviously Eli Lilly is in the same segment with them. The report from Eli Lilly indicated that some of those challenges have started to ease, and that sent the stock share price up by 4.14% for the week. Obviously, a few investors were lucky to have grabbed the share at those lower prices. That's what you get by paying attention to what goes on in the market every minute of the day. Lastly, we have reports from Intella Therapeutics. It was also a miss by a wide margin. The actual revenue came at 6.96 billion compared to 19.2 million. Actually, million. The revenue came at 6.96 million compared to $19.2 million estimated. That was a miss by over 60%. You also had the EPS coming at minus a loss of $1.52 compared to $1.21. The share price is down for the week by 4.11%. And the last company I'll talk about is Occidental Petroleum. The revenue came at 6.88 billion compared to 6.65 billion. The company also beat in terms of earnings per share, which came at 1.03 compared to 0.77%. But the company is down for the week by 0.21%. To my listeners, this is where we wrap it up for the week. Thank you for listening. If you haven't subscribed, please hit the subscribe button. I appreciate your support and you must keep it coming. Until next time, I'm signing out. Nathan.